It's the disclosure thingy.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors or registered broker-dealers. Nothing contained in this webinar, website or promotional material constitutes a promotion, recommendation, solicitation or offer of any particular investment, security or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
Okay, a couple of weird pauses there from the new guy. I don't know what goes on with these things. You would think this would be something they could solve. If they can't solve this, why are they letting these things drive? That's what I wonder. Speaking of which, Uber just canceled their self-driving project in Arizona. So apparently that wasn't working out for them. This stuff is not ready for prime time, so I don't think we should get too excited about the robots taking over yet. Anyway, excuse me. Holy cow. I thought I was wide awake, but I'm not. Anyhow, so let's see how the market's doing and what's going on, and then we can chat otherwise. We have a little bit of a bounce today coming back. I was just going to say I wanted to short the NASDAQ, but it's already falling. Still want to short it though. Look, see, we're right at 6,900. It's a great place to short. So let's go to Active Trader. NQ. You know, the reason it's a good place to short, the reason it's a good place to short is because you can use that 6,900 line as a stopping line, but not if it's going up. So let's see what's going on. The Russell is going down. The S&P is at 27.15 and the Dow is at 24.68. I still think it's a good spot to short. I'm kind of looking towards it being short. I'm kind of thinking we're going to sell off a bit here. I'm not in love with it, but the point was I wanted to say if it's below 6,900, it's a good place to short, because then if you get over 6,900, you stop. It's kind of being a little weird though around that line. So I think let's have a lesson of don't play. So it's not doing what I thought. I thought it would get below 6,900 and stay there. It's not doing that. So there's really no sense in playing it until we see it behaving itself a bit. My leanings are though that it should go lower, but I don't really have a lot of conviction because everybody else has already sold off and we haven't had much of a bounce. So we'll get back to this in a minute, I guess. So I thought it was going to be an easier trade to make, but it won't be. What else do we have going on? Oil came down nicely. Gasoline came down a bit. But that was actually probably should have gone long there on the report, because you still got the weekend coming up for the holiday. They're still going to jack the prices up. It doesn't have to be for any good reason. They're going to do whatever they can to jack these prices up. Gold was doing good at 4 bit. Where is gold? We don't have gold. Gold was doing good for a bit and it fell apart. Silver tested 1640 and held it. Let's see, YG. Yeah, so and see, gold was up at 95, fell back to 85. Now it's at 90, so it's splitting the difference basically. Coffee finally moved. Where was coffee? Casey. Oh, here. Coffee finally moved. We took this money and ran the other day, yesterday, in fact, because look, when you get a good run of like 3 cents, and in coffee, 3 cents is a good run. If it starts faltering there, you say, fine, I'll take the 3 cents and then we'll see what happens. So now we're in the see what happens phase. Probably won't get back in until after the weekend, though. Natural gas off to the races. That one, that's going to go way over 3 at some point. Don't know when. Okay, I'm back on the NASDAQ, though. Let's do this. Let's take one short. Right at 69, and we'll see what happens. Because the Russell looks really weak. The S&P's failing 27.15. The Dow's falling. Why shouldn't the NASDAQ fall too, right? It doesn't make any sense. So, I mean, obviously the NASDAQ could not fall just because Apple had some good news. But let's do 2 and see what happens. So if I get it, I didn't get the second fill. Oh, there it goes. Okay, so now I got 2 at exactly 6,900. And hopefully it won't go against me too badly. So that's that. Charts and good. And let's see what we talked about this morning. I know we had some important conversations this morning. That SEO trade from last week is still in play. We just looked at it. It's actually, if you were doing the SEO trade from last week, which was the 15. Let's get on this thing. Last week we talked about doing the SEO trade. It was right at the beginning of the webinar. And in fact, we just had a big build in oil today, which is what I said would happen last week. If you go back to last week, I was talking about I was talking about the way, into the holiday, how the gas stations fill up. And so, of course, there was going to be a drawdown coming into the holiday. And I said, by next week, though, they're done. They're full. You have to think about like how the whole thing works. So there's all these storage tanks, and I forgot the number, but last week I looked up the numbers and everything. There were all these storage tanks at all these gas stations, and whether they're half full or quarter full or a third full, whatever they were, they all made sure they were full as of before today. It's a holiday weekend, so the gas station guys aren't stupid. They're not waiting until Thursday or Friday to fill up their tanks. They're making sure at the beginning of this week they have full tanks so they can sell as much gas as humanly possible this weekend, and hopefully at high prices. So that gas is in the ground now, and that means this week they don't need as much. So what happened today? There's a $6 million build, a $6 million barrel build in oil, because the gasoline stations are like, we're full. We don't have anywhere to put this stuff out. There's no sense in refining it. We got nowhere to put it. So that's how these things, they get ahead of themselves, and then it catches up, and then you have a big sell-off. That was what we expected to happen. So the SEO, we looked at the June 15. Where is SEO now? We looked at the June 15-17 spread, and at the time it was $1, and it's still about $1, not a little less. It's actually 130 and 90. Oh wait, no, I'm sorry. It's 130 and 35. So it's actually 95 cents. It's actually cheaper now than it was when we took it last week. But because the 14s are $2. Well, they were cheaper earlier this morning. The 14s were, at some point, the roll was able to be executed that we wanted, where it was 45 cents to roll down to the 14s. So that spread is now the 14-17 spread. The price went up now, I guess probably because people were doing the rolls, and now it's closer to $2. And at $2, if you can only get 35 for that, it's no longer worth doing. It was worth doing this morning, though. And that's why you got to put in your order to make the roll, and then hope. And the thing was, what happens when we spike down, when SEO spiked up this morning, it didn't spike down, it spiked up this morning. When SEO spiked up on the inventory report, what it did is it raised the price of the short calls of the 15s faster because they have more premium. That went up faster than the price of the 14s, which had no premium. So because they were in the money. So it made for an easy roll this morning. Now it's gone. But if you're going to do these rolls, you got to stay on top of them, or put the order in, and eventually it fills. There's ways to do it. Anyhow, see if there's any immediate questions. Sri says, can you take a look at NYCB? The bank started to pull back on business to avoid 50 billion limit. The rule is now gone. Survived the recession in great shape. That is a great premise. So what Sri's saying is that the NYCB, which is a great bank, New York Community Bank, they basically purposely tried to keep themselves under the limit where they get affected by the Volcker rule. And now they've taken away that limit on the Volcker rule, so they no longer fear getting bigger. And all they were doing is purposely keeping themselves under the regulatory radar because it was too annoying for them to cross that threshold. But now they're immediately able to go out and do whatever the hell they want because we've taken the reins off the banks again. It's been 10 years. They haven't destroyed the market in 10 whole years, so it's time to give them another chance at it. And it's not these guys. There's nothing wrong with NYCB. They're a good bank. It's the JP Morgans and so on and so forth who really destroy the economy. Anyway, but it's kind of funny to me just to how can you have gone through the financial crisis and now say that you're going to now take away all the regulations that we put in to prevent another crisis? On the poor banks, they can't make enough money. It's insane. Okay, the poor banks never really made the kind of money that they think they should be making because they were lying when they made it, and they were cheating, and they destroyed the entire economy and almost bankrupted the country. And ever since then, they've been whining about how they can't make that kind of money when they lied and cheated and stole. And now finally they've got an administration dumb enough to go, oh, okay, well, let's make sure let's take away those rules then. Let's get back to business. It's disgusting. It really, and it's not like, come on, they're not dumb. They know what they're doing. The Republicans know what they're doing. They know what the repercussions are. They don't give a crap. As long as they get campaign contributions, they don't care what happens to the country. It's really disgusting. Anyway, so meanwhile, the question is NYCB cheap at the moment? That's one thing. Because yes, they have a great growth story now, but are they cheap? Yeah, they are cheap. Look how low they're trading in the channel. That's fantastic. Now, are they worth it at that price? So now let's go over here. Let me put an NYCB here. And 12, I know I would like them $12. The PE says 13, so we're going to see if that's real. 5.8 billion. So their PE is 13. They're going to be earning something in the neighborhood of $500 million. Let's see what they're actually making. Yep. Okay, that seems reasonable. Okay, and there's no hanky-panky. It's pretty consistent year to year, so we take that as a real thing. In fact, they had a little bit more expenses here for whatever reason. Okay, that's pretty acceptable. Revenues are basically flat, and as Sri noted, they're flat because they don't want to get any bigger. They don't want to get any bigger because otherwise they hit the regulatory threshold. Now they can start growing. So now you're looking at this number. See, the thing is, investors, traders are looking at the number and saying they've been flat for years and not making any big money. That's not the real story, though. The real story is they've been holding themselves back. It's like a horse. It's like that. It's like a racehorse where the jockey's been holding it back. So they've been holding back with massive cash flow. Holy cow, what do they do here? Oh, they paid down a lot of debt, apparently. See, they have this 1.5 billion debt, paid back 2 billion, paid back 760. It's a lot of that. Huge cash flow here. This is amazing. I mean, considering they're a $5 billion bank, it's pretty good. Investments have been paying off for them. They're doing good there. They're firing on all cylinders. This is a great operation. Okay, I like it. I agree. I agree so much this has to go in the long-term portfolio. And they pay a 5.75% dividend. Holy cow! How could you not be buying this thing? All right, so in the long-term portfolio, all right, so you make a note of this while we're doing it so I don't forget. I always forget, so I'm going to start page down. This is some real behind-the-scenes stuff. Because this is how I get paid the big bucks. Okay, so NYCB is very cheap, and as noted by Sri in the webinar, now that the rules have been rolled back, they can expand. And nice 68 cents. Nice 0.68 dividend on a $12 share is 5.75%. While you wait. So let's add them to the LTP as a dividend pair. So if I'm going to add them to the LTP, I need a picture. Don't have any pictures, so I have to steal. Okay, so I do this all the time. It's like I never know the site, so I just hit the right click, open in a new tab, and now I have a tab for making the pictures. And it's NYCB. Copy image. Okay, so what are we going to do with them? We're going to buy. How much do we want to buy? In the long-term portfolio, we have $500,000. So we have $1 million. We have $50,000 allocation blocks. So 1/20th, we have $500,000, which means we have $1 million in buying power with ordinary margin, which is what I always go by. And that means that if we divide that by 20, and we have articles on this called Smart Portfolio Management in our education section. I write all about how to allocate portfolios this way. And then the whole strategy section about how you scale in and such. But anyway, so an allocation block is $50,000. That means that we're very comfortable having 1,000 shares is not even a thing. I think in this case, since we think it's very bottomy, I think I don't want to start with 1,000 shares. So let's say we'll buy 2,000 NYCB at $12. Okay, and that's going to be $24,000. We're going to sell 20 because I know we're going to fully cover. Well, maybe we won't fully cover. Let me think about that. Let's see what their options look like first. NYCB. All right, so they only go out till January. That's bad. They're at 12 even. We can sell the 12 calls for 11. Now, if they're 68, that means you divide by 4. It means they're going to be 32.16 cents is going to be the dividend. So as long as the premium is more than 16 cents, which it is on the 11s, I may as well sell to have more protection. So I think what I'm going to do here to maximize the amount of premium and play them bullish is I'm going to sell 15 of the 11s for $1.40. So we're going to sell 15 January 11 calls for $1.40. 15, not 14. And we're going to sell 15 so that we can sell short calls. So that's so 15 January 11 calls. All right. And I'm going to do some math here. So 15 times 140, $2,100. So that's going to be $2,100. And we're going to sell, let's just sell 10, but we're going to sell aggressively the January 13 puts. So we're going to obligate ourselves to buy just 1,000 more at $13. And I'm doing that because I do really think they're going to go up from here. So I may as well sell the 13s because they're going to pay us a lot more. If we sell the 12s, yes, it's more premium. It's 85 cents, it's 90 cents in premium versus $1.45 in premium or $1.50. I'm sorry. Sorry. If I sell the 13s, it's $1.50. I get 50 cents in premium. If I sell the 12s, it's 90, but it's all premium, so it's 90 cents in premium. So it's a lot more premium, but I'm taking into account the fact that I think the bank is very cheap here, and I'm only going to do a half sale, so I'll collect more money in cash doing it this way. So that's my goal. So I'm going to just sell it. I'm just going to just sell 10, but we're going to sell them for $1.50, the 13 puts. Still nets this thing cheaply. So we sell the January 13 puts for $150, and obviously that's $1,500. Okay, and that's going to make our net. So we can sell more, obviously, if we decide to afterwards. If these drop down and the thing starts looking strong and they're 90, we could sell more for 90 and do very well. All right, but we think, basically we're netting in for $11.50. That's the line we bounced off over here, so hopefully it should hold. So that's net 6. 24,000 minus 6 is 23,400. Minus another 3 is $20,400. And if we get called away at 11, that's $22,000 plus probably 3 dividends left, and we'll find out that for sure. So let's go back to Yahoo, and we'll look at the historical data, and we'll see what they paid so far. They paid a dividend May 7th. That's a shame. We just missed it. They paid another one on February. So they've got 2 dividends left this year. So I'm only going to collect 34 cents in dividends more. So 34 cents times 2 is 68, and $680 plus 680 in dividends is dividends. Oh, forgot an I. All right, plus 680 in dividends is $20400. Oh no, I didn't do that right. So it's 22,680. 22,680 minus 20400 is 2280. Is 2280 in profit in just, is that right number? Yeah, in just what, like 8 months left? In just 8 months. So it's about, yeah, it's 10, let's call it 10%. And we can also make some extra money. Remember, that's why we sold 15. Selling 5 short calls along the way. So it's not an aggressive play. We're leaving it very, very, like, we'll see what happens. So we can do a lot of things with it. We're only half committed to doubling down. We have sold 2/3, 3/4 of the puts. So hang on. Let me get bold and indent it, and then it's an official play. Okay. So let me just bang that out. So basically what we're doing is we're taking 2,000 shares of the stock. We're reducing our cost to 20,400, which is obviously $10 a share. So we're dropping our net entry to $10. We're selling 3/4 coverage of the 11 calls. So we will get called away at 11, which is lower than it is now. So we have very little risk on this trade. If we do get called away, we're going to get we're going to make 10%. That's even if it drops all the way to 11, which is $2 a buck down from here. So it can drop 10%, and we're still going to make 10%. Obviously we have a 10% cushion below that. So this thing can drop 20%, and we still break even on it. And we'll collect the dividend either way. So it's a good way to get started with it and take a look and see how they do for the next couple of quarters. If they start going up, we're only 3 quarters covered, so we'll do very well on the 5 open ones. We'll still collect our 10% at least. And though, once they get back around, maybe if they pop back to 14, I would start selling some short calls. Currently, the July, well, see, these are useless. We have to go by what's out of the money. The July 12s are 35 cents. So for 2 months, we can collect 40 cents, let's say, over 2 months. So once they get to a point where we can sell the 14s for 40 cents and they're 2 months out, even if it's only for 3 times, even if it's only 6 months worth of sales, we're going to collect another, and I know it doesn't sound like much, but it's another $800. It's more than the dividend. So if we collect $800 3 times, that's $2,400, just bonus money. No, I'm sorry. Wait. No, I messed that up. It's not going to be that. It's going to be half of that. So it's my mistake. Sorry. We're only going to sell 5 covers, so it's going to be $200. Wait. 5 times 40 is 200. Sorry, it's $200. So we'll collect another $600, which becomes the same as the dividend. We're only going to, in other words, the 5 uncovered calls. We're going to sell short-term calls and pick up 200 here and 200 there and 200 there, and we'll pick up another $600 against the spread, which is another 3%. It's not nothing. And maybe we'll get more confident when we get close to 15, maybe we'd be more confident. We'll sell 10 short calls and make a little bit more money. But that's how you do these trades. You just grind them out and make a little bit of money, make a little bit of money. There's some trades where it's just designed to do that. But you're still talking about in 8 months, 10%, 12%, 13%. That's a great way to play the market. Not every trade has to make 100%. There's definitely room in your portfolio for these nice, steady trades. In fact, Doug, who trades our hedge fund, he's not typically an LTP player. He's been trading with us for years. But before we started the hedge fund, he's more into the short-term trades, which is very important for the fund because he uses it to cover. But he's more into into making a quick trade, like Tesla's too high, I'm going to short it, Netflix too low, I'm going to go long, that kind of stuff. Quickie momentum trades, which is, definitely fine if you like that kind of trading. I don't, because you got to sit there and stare at the screen all day. But since he's been doing the fund, which has only just started this year, has more and more of these long-term trades in that portfolio, the ones I like. And he was just saying, he's like, Phil, you know what? I never realized what a pleasure it is that when I don't do anything, money still comes in. Because these long-term trades of ours, they just crank out cash. And as I pointed out today in this morning's article, we have in the long-term portfolio, where was it? It's probably gone now because it had a bad day because the market crashed. But let's see. In the long-term portfolio, as of yesterday, here it is. When we did the review on Friday, we were at 773, and now we're doing the review today. We're at 786. So it's up $13,000 in a week. In 3 days. That's nothing. That's completely. I haven't even made the adjustment. I don't even think we had any adjustments, frankly. Did we? That's a good question. Phil Stockworld, May portfolio review. Let me see. That is our, what is this? Long-term portfolio review part 1. So this portfolio as it stood, did we have any adjustments to even make? Yes, we were going to make this adjustment, which is CMG, but we didn't yet. We didn't. I didn't make the adjustment officially in the portfolio yet. And that's it. So there was one adjustment, but without making that adjustment, we made $13,000 in 2 days. These exact positions without being touched. So that's what he means. So obviously, if he does, because Doug's usual thing is he either trades and makes money, or he doesn't trade and no money comes in. So he's kind of every day he's got to trade if he wants to make more money. And by now having the hedge fund where half of the positions or 2/3 of the positions are these long-term trades, he's like, wow, this money just keeps pouring in. It's crazy. And why does it pour in though? It's because we're being the house. I don't know how. I mean, it's a whole theme of what we do, but I mean, it's being the house. It means that we're selling risk to other people because we know for an absolute mathematical fact of life that risk premium that we sell will evaporate over time, which means we steadily make money from all the people who think they know how to time the market. And we don't really care, and we don't randomly do it either. That's the thing, though. There's a lot of people who have risk selling strategies, but they treat it like it's a random thing. And the real difference of what we do is that we're also fundamental investors. So we take the risk, but we take the risk on something that we feel has a value, and we hedge the risk more towards saying we think this stock will go up, but we'll sell this premium. Just like I just did with the other one, right, on the dividend stock, on the bank. We think the stock is going to go higher, but that doesn't stop us from selling some premium on it and along the way. So we'll take a bit of a bullish position. Like I sold the $13 puts on a stock that's currently $12. So that's me saying, look, I'm going to sell 50. Like I said, I sell 50 cents worth of premium instead of 90 cents worth of premium, because the 90-cent worth of premium is a chicken shit sell. I can only make 90 cents because if it goes higher, I'm still only make the 90 cents. In this case, though, I'm selling 50 cents worth of premium at the same strike. So my downside is no worse because I'm selling 50 cents worth of premium at the same strike. I only have 40 cents worse to the downside if I'm wrong. But on the upside, I can make up to $1.50, and that's 60 cents more than I could make if things go the way I think. So what's my risk? My risk is 40 cents. My reward is 60 cents. I'm taking a positive risk-reward profile that's significant. It's 2/3. It's 60-40 is 2/3 in my advantage, or 1/3 my advantage. So I have a 33% advantage net in that trade. And if I have a 33% net advantage, I only have to be right 4 out of 10 times. I'm going to win. Because what's 4 times 1.3? 4 times 1.3 is 5.2. That's the math of the thing. So if I have a 33% advantage in my trade, and if I'm only right 4 times out of 10, I'm going to make more money 1.3 times on my 4 than I'm going to lose on my 6 that I lost, and therefore I will actually win by 5.2 over 4.8, which is actually significant. That's a 10% win even when I'm wrong. I know it's a lot of numbers, but you got to, you need to think about that and write it down. It's like really important stuff because people don't understand that. There's little tiny changes that you make. And this is, believe me, this is what a casino understands. These little tiny changes to the odds, like adding a double zero, right? There's a 0 on a roulette wheel. That 0, though, if you're paying in the roulette, first of all, there's 36 numbers in a roulette wheel, right? They only pay you 35 to 1 if you win. So right away, they're stealing $1. They're stealing 1 point from you. That 1 point right there gives them a 3% advantage. But the house isn't satisfied with a 3% advantage. So they add a 0. So now, not only do you get paid 3% less than you should when you win, but now they're adding a number that also doesn't get paid. So now you've got a number that you can bet on it. You still get 35 to 1. But now there's 37 numbers. So there's now a 6% advantage to the house, or a 6.5% advantage to the house. Then most casinos these days are greedy and they add a double 0. Still pay you 35 to 1 on the numbers. So now they have a 0 and a double 0. So now there's 3 numbers out of 38 and you only get paid 35 to 1. So now you've got almost a 10% disadvantage every time you spin the wheel. Do you know what that means? Every time, mathematically, every time you spin the wheel, on average over a long period of, in other words, when these statistics play out, what happens is you're losing 3% every single spin. And obviously sometimes for a brief streak you'll be up and for a brief streak you'll be down, but over time you're getting grinded down 3% per spin. So if you have $200, you will lose $6 per spin. And I can predict, and believe me, I think I told you guys, I had a girlfriend of mine. She worked at Caesars doing this stuff. This was her job. I was always fat. Maybe she shouldn't have showed me. I don't want to say it. But it was always fat. I'm sure she shouldn't have shown me. So she didn't show me, but I would be fascinated had I seen all the numbers and statistics and all the sheets that she had been working on in secret that I could never see. But if I had seen it, I would have seen all kinds of fascinating stuff. And it would say that if you walk up to a roulette table with $200, that they know you're going to lose $6 per turn, and therefore they know that you're going to sit there for, and they know how many, they know it takes 2 minutes for a roulette cycle to go through, from the time the guy spins the wheel to the time they collect the money, to the time they place the bets, to the time they make a new spin, maybe 3 minutes. So they know that in 1 hour of playing roulette, you will lose $180 of your $200. Okay, and they also know that most people are going to walk away after about a half hour of playing when they've lost $100. And they will lose half their money, and they will feel like, oh, I lost it. Another certain percentage of people, though, are going to actually take that last $100, bet it all on one number, and hope to make it all up in one spin, which is, of course, idiotic. But you know what? It's no different when you look at traders. You all do the same thing. We do it. I do it. Everybody does it. It's just human nature. It's like when, you have to fight that in yourself. When you want to become a professional trader who makes money all the time, you have to fight these basic instincts people have. But these numbers that I'm talking about, we can take advantage of it by just simply taking the other side. Don't be the idiot gambling. Take the other side of the table where we know for a fact we're going to grind out money every time somebody plays with us. And it is 100% in our power whether or not we let people gamble on our positions. That's why sometimes we sell options, sometimes we don't sell options. Sometimes we're bullish, like with, GE is a bad example. It's probably hitting our portfolio today, but let's take GE. And we'll see how the long-term portfolio took a hit again. Wow, easy come, easy go on that money. All right. But, we don't really, the day-to-day stuff is just silly. It's just record keeping, but it's fun. It's like just interesting to watch to see how you're doing. I'm sure the short-term portfolio took a pop, though, so we'll find that out in a minute. So in GE's case, which obviously today they dropped a buck because they just had the CEO just said they're not going to make any money this year in one of their divisions, and the stock took a tumble. But that doesn't change our long-range outlook. It just means we were stupid not to sell some calls when it was at 15. Meanwhile, so I was greedy. I should have sold. It went, GE went to, they hit 15. See that? They hit 15. They popped up, and just today, bad news, and they popped back down. So they look good. I thought they were going to break up to 18. I didn't want to sell. But we should have done at least a half a cover. It was stupidly greedy. Because if we'd done a half cover, we'd be in great shape right now. But anyway, so what was my point? Oh, yeah. So some things like GE, we say, damn it, this is way too cheap, and we're not going to cover. Other things, we sell heavily against it. Some things we're practically short. We sell so much premium against it. But that's fine. It's based on our fundamental outlook of each position. Like Chipotle, like we have, this was actually the only one we adjusted because we were so far, it blasted so far over what we expected that we're not even making money on the position yet, but we'll just have to work our way out of the short calls. Anyhow. So all that was off the first question. Let's see. Let's see what question number 2 looks like. Good God, we'll never get done. Okay. May says, I have the LB 2020 30-40 debit spread. Now in the options opportunity. Instead, oh, wow, wait. Are you telling me we only have the 30-40? I hope not. Am I wrong? LB. Oh, you're right. I thought we rolled those lower. Or maybe we did roll them lower, but I haven't logged it yet. So in fact, let's see. LB. There it is. Okay. Okay, yeah, that's after the change in the OOP, which is not reflected yet. Instead of the 30-45 spread, should I hold them into earnings? Oh, I see. You have the 30-40, and should you hold into earnings? And should I sell? There's a lot of questions. I think LB is going to have good earnings tonight, so I think they're going to have good earnings. So what's going to happen if they do? It's going to pop, and you're going to be stuck in the position you have now. I think you say you have the 30-40 bull call spread, and the question is, should you spend, if you want to widen this is 350, let's say, the 40s, and the 45s are, well, if it's 250, I would spend, for 250, I would spend $1 to widen the spread, just because that may not be available again. It might cost $2, and then that's a real waste. And $1 is no big deal. So for $1, I would do the roll from the short 40s to the short 45s. But I don't think it's going to come out to $1. For $1.25, I wouldn't. For $1, I would, because it seems silly not to. You're going to push 4-1 against, when you're doing it. If you have the 30s, is it worth it to roll to the 25s? Those are 720, and the 25s are. See, that says 10-10. Still not worth it. It's still $3. I wouldn't spend $3 to do with a roll. If it's 250, I would do it. If it's not 250, I wouldn't do it. So your cheapest way to put more oomph into the play is to spend $1 to roll the 40s to the 45s. And if you can do that, great. Now, question number 2. Earnings are tonight. If you sell the 30 puts right now, you get $5 for the 30 puts. The 25 puts are $3. You're not going to get $5 again. If it pops, if they pop 10%, you'll never see that price again. Now, what if they go the other way? Well, if they go the other way, let's say they drop 20%, $7. That brings them down to $27. If they're $27, if you sell these guys for $5 or $5.20, if you sell the 30 puts for $5.20, you're netting in at 24 something. So they'd have to drop 30% before that hurt you. All right. So for me, I would sell them now, or at least do a half sale, rather than risk not collecting that premium. That just seems like shameful not to do it. In fact, if you do a half sale, think about it. If you do a half sale and then they drop 20%, and they're still going to be at, what do we say, $27.50, right? So these guys will be, if they're 30 now, they'll be where the 37.50s are. These guys will jump to $10, but then the 22.50s will be $10, and you can roll to 2 times, because you only did the half sale. You can roll to 2 times the 22.50 puts, and you will have effectively sold them for $2.50 each. So your net would be 20. And then see, now to me, the thing is, if you don't want to buy the LB at 20, why would you be playing it at all? So for me, that's a no-brainer, doing a half sale, because you're effectively promising to buy LB for net 20. Because even if they drop, you're going to do a 2 times roll to the 2250s, and then you'll be netting in for $2 for $20 on whatever it is you're committing to. And so with LB at 34 right now, and you say to me, are you willing to commit to own 1,000 shares at $20,000 when it's $34,000 now? I'm like, of course I am. How many can I get? Can I only get 1,000? Can I get 10,000? Can I get 30,000? How much can I buy for $20 right now? Because I like them. And if you've got the 30-40 spread, where you don't make money until it gets to 35 or something, if you've got the 30-40 spread and you don't think you should sell the 30 puts for $5, you shouldn't be in the 30-40 spread, should you? So you always have to have that attitude. It's like, don't play a stock you're not really that into. It doesn't make any sense. And yeah, they could miss earnings, so I'm willing to do a half sale. But if it wasn't for the fact that they might miss earnings, and they might because they're in a turnaround, it's not necessarily like this quarter is going to be the one when everyone realizes that they're going to do well. So maybe they miss, maybe they have something disappointing to say. But if they do, so what? I'm still going to stick with them. Unless something tragic happens. Same like GE right now. GE went down $1. I'm like, I don't care. The CEO didn't say we're falling apart. FTR also. FTR was trying to sell some part of their property. They didn't get a good price. They said, you know what, we're not going to sell it because we don't need to. So we got bad news on several fronts today. FTR went down because they were trying to sell some of their Florida stuff that they bought from Verizon, but they thought they were going to get a good price. They didn't get a good price, and they said, no, we're throwing the offer then. No, if nobody wants it for the price we want, we're not selling it. There's nothing wrong with that. All right, it's like if you try. I mean, realistically, let's say you try to sell your house. You think you live in $1 million house. You try to sell it. You can't get more than $850 for it. So you say, screw it. I'm not going to sell it. I want $1 million. In theory, your net worth took a $150,000 hit, right? Because you were saying you had $1 million house. Now you have an $850,000 house. Clearly, you can't liquidate it for $850. Or $850 is the best you can get liquidating it. Therefore, that's what it's worth. But you can't logically price everything at liquidation value. You're only if you're forced to liquidate it. So if you look at like Sears, for example, is probably going to be forced to liquidate. So then you have to price their assets at the liquidation value. Whereas Macy's is not forced to liquidate because they're in good shape right now. So Macy's, this is where our analysts are so far different, right? Because if you're going to value Macy's stores, you would value them at the current going rates for properties, not at the liquidation value, because Macy's will sell them off whenever they damn well please. When they get a good price, they'll sell a property. And they're not really in the property selling business anyway, but that's beside the point. But if I'm going to value Macy's, I'm going to look at the fair market value of their buildings, not the liquidation value, because they're not going to be forced to liquidate. But Sears, having very similar buildings in very similar places, I'm going to look at the rush sale price because they're most likely going to have a rush sale. That's how you can have two analysts who honestly, based on that difference of opinion right there, can have wildly different prices for things that you would think are the same. So my take on LB is if they go to $20, it's going to become a major part of my portfolio for the next 20 years. Because I have that long-term faith in them. And Macy's, which we did not buy Sears last year, but we did buy Macy's last year. Macy's, I would have no problem owning for a decade if they had to work out of a rut. Sears, if they have to work out of a rut, they're not even going to make it long enough to have an investment. So, you have to look at that. You have to look at the big picture on these things, not just what's going on right now. Again, this may sound like a dumb question, but I get a little bit confused on your Phil Stockwell free Reddits. Do you really want us to cash out our OOP portfolio and hold cash, or just hedge the OOP portfolio? And you can let us know how much of a pullback you're expecting. I'm expecting a 10% pullback. And do I really want you to get out of the options opportunity portfolio? If it were my money, and I said this last week when we were 4% higher, if it were my money and my choice, I would have cashed out last week and gone on vacation for the summer and come back in September and then seen what there is to buy. Okay, I'm not in charge of you, though. I'm just running sample portfolios. These are educational portfolios, and the idea is for you to see how to manage them, how to manage a portfolio in the market. But if it were my money, I would have cashed it out. It's not my money. I'm just teaching people how to run a portfolio. So, given that there's no point in teaching people to go on vacation, although I could do that too. I should do that. I should just have a travel website for the summer. And I'll go to old cool luxury hotels and eat at fantastic restaurants. I'd be like Robin Leach. Oh, I'd love that. I don't know if you guys know. I don't know if you're young, you wouldn't remember. There was a guy, Robin Leach. He had this show, Lifestyles of the Rich and Famous. And his whole job was traveling around the world, going to like incredible parties in incredible places and hanging out in people's mansions and yachts and interviewing them, basically, and talking about how fabulous their lives were. But meanwhile, he's the one partying like a rock star constantly. Damn. Why didn't I think of that sooner? That's a great idea. I think I might do that. All right, see you guys. End webinar. Anyway, so that's what I would have done for the summer if it were up to me. But it's not. My job is to sit here and teach people how to run portfolios. So we're still running it. You will endure pain in the portfolio. It may even go negative from being up 10% or up 15% as of Friday. If I felt it wouldn't recover ever, I would have cashed it out completely. I don't feel that way. I do feel that we're going to have a dip and then we'll come back. And that dip will be an opportunity because we have plenty of cash on the sidelines and we'll probably come back stronger than we did. But meanwhile, it's going to be a stress, it's going to be a hassle, and it's going to be iffy. It may not. Maybe we don't come back. Maybe something horrible happens. Maybe we cascade into a pit. So it's up to you as to how much stress you want to handle in a portfolio. But like I said last week, so when you said you really want us to cash it out, I was explaining that last week. I'm saying, look, you're up 15% in just over 4 months. We only need to be up 20%. 15% is how much Berkshire Hathaway averages. They average 16%. Over all the years of Berkshire Hathaway, they've averaged 16% a year in growth. So when you're up 16%, you're as good as Warren Buffett. And if you make 16% every year, you'll be as rich as Warren Buffett. So that's not even, it's barely a realistic target to be up that much. So meanwhile, when you're up 16% in 4 months, you got to say to yourself, you know what? I don't really need to work now. I don't need to sit here and do this. I can do something else. You know, develop another skill that can make you money aside from sitting around trading all the time. Or just take some tiny portion, or cash out, take 5% of the 15% that you made and play the futures and short-term trade it and practice that instead. But when you're risking 115% of the money you started with at the beginning of the year and you have a 10% correction, that 10% correction is going to wipe out your entire thing. It's going to be 10% of 115%. It's going to be 11.5% taken away on a 10% dip, at least. And plus, we're playing with options, so we have leverage, and it might be more than that because we're leveraging our positions. So maybe we'll skillfully go through it and come out on top, and maybe we won't. Maybe there'll be a misstep. Maybe it'll go down further than we think. So if it were me, I wouldn't risk it. And as I've said, both my kids' college accounts, I cashed them. My oldest daughter, Madeline, starts college next year. Jackie has 2 years to go. They both have $250,000 in their college accounts. I'm not going to risk 1 year of their school on a 20% correction. Plus, it's bullshit. I can't hedge it. It's all ETF garbage. So I said I can't protect the 250,000 they have other than cashing it out, so I cashed it out. All right, and if we have a nice dip, I'll go back in. But if we don't have a nice dip and the 250,000 covers their education, why should I risk it at all? It makes no sense. You know, I mean, we started with bad timing, but we started in when Jackie was born. I didn't do it when Maddie was born. When Jackie was born, I started both accounts with, I believe it was like $100,000 in each account. And so in 16 years since then, it's gone up 150%. So, you know, it's gaining about 10% a year on the average. It's not terrible. You know, compounded. I mean, really, it's just ETFs and stuff. It made it through the crash. It made it through 2 crashes, really, and recovered. So now the thing is, so that's the point, though. It made it through 2 crashes and recovered. Now, if there's another crash and it drops 50%, right at the exact time they're going to go to college, I'm screwed, right? So right now, my children have completely, from their perspective, it cost me money a long time ago, but my kids have completely paid for college educations. Why would I risk that? That's crazy. And not only that, though, but when you look at the tax-wise, the gains don't even help anymore, because once the way these 504 or whatever they're called, I think they're 504s, the way these college plans work is any money you have left over at the end, after you pay for college, gets taxed at, like, I think 50%. I think like half the money you have to give up in taxes. Whatever you have left is 50% taxed. I'm pretty sure that's what they said. So there's hardly any point. So there's really diminishing returns trying to make more money, because we're already over what they're going to have to pay for 4 years of school. So anything I make now, I'm only making 50 cents on the dollar for what I risk. So now I have to make double returns just to get it back. And that's really not even the point of what this money is for. It's not there to make money in the gamble. It was there to pay for their college. We successfully paid for their college. So stop. So I'm not here to tell you what to do with your money. You've got to think about what you really want to do with your money, and what you want to do with your time, and how much risk you're willing to take, and so on and so forth. But I'm just saying, I think this is a stupid time to risk money in the markets. I want to make sure everybody's very, very clear on that concept, because, you know, much as we'll still play stuff, we're playing stuff because that's my freaking job, to sit here and find plays and pick something to buy. But on the whole, I think it's a bad idea. I think it's time to not trade. So that's where it is right now. And Sri says, learning more by being a trend watcher. Okay, cool. Oh, you're a trend watcher member. That's nice. That's our most popular membership right now. A lot of people signing up for that. Put on my hand, did a long call, 1013 yesterday. Was thinking it would shoot up. Hoping to sell $15 calls when the price work up. Yeah. Yeah. He's saving up to be a premium member. Can't wait for you to join us. Yeah, because that's cool. Then in the chat room, we can do this all the time. Consider IRM for a trade. Is that Iron Mountain? I get mixed up. I used to like Iron Mountain. I don't anymore. Iron Mountain, yeah. Okay, here's why I don't like Iron Mountain anymore. Iron Mountain stores documents. The problem is nobody has documents anymore. So they have a business of diminishing returns. You know, the point of Iron Mountain was to store your paper. Now, as we've been Iron Mountain went through a very big boom time, because as we've been digitizing papers, the companies, even the ones that digitize the papers, they wouldn't shred their papers. They would send their papers out to store, and Iron Mountain has cheap paper storage. But that's not how things work anymore. So their business model is busted. They're still the best storer of papers and things in the world, but they have the overhead of owning all these storage facilities. I know they keep talking about we'll repurpose them, and instead we're going to store data or some bullshit like that, but they're not experts in that. IBM and Microsoft and Google and Amazon are storing data on massive server farms that Iron Mountain can never in a million years compete with. Hey, believe me, I like Iron Mountain. I love them as a business. I was gung-ho for them in the old days, but it's over. It's not a live business anymore. It's just a business that's winding down over the next decade. So that's the problem with them. Let's see if we can see some financials that show. IRM. Money. Here we go. Actually, the revenues are good. I mean, it's got revenues coming in. The income is growing. So I mean, they're actually doing better than I would have thought. And let's see if they change their profile. What are they saying they're doing? I want to take a look at that. Storage and information. Trusted one for 85 million feet, 14,000 facilities. Blah blah blah. Critical information, sensitive data, cultural and historical artifacts. Well, that's not going to go away. Digital. See, I honestly, the cloud services. Since everybody who has cloud storage is making money, they're probably making money on that for now. But long term, it's not going to save their business. That's my theory on it, anyway. So, it's obviously not happening right now. But look at this PE though. Look at for $9 billion, and they only make $200 million. That's 40. Yeah, that's 45 times earnings. You're paying way too much of a premium for a company that I don't even think is. I'm surprised that they're doing so well. In fact, let me look. Hang on. Oh wait, you guys can look. I thought I had to go to my other computer. All right. So we go IRM. Oh no profile. Oh well. See, sometimes there's a profile, and then I can figure out like how much of their business comes from each thing. Anyway. I don't see it as just a long-term thing. I see them moving into an area where they're going to have huge competition. But cloud is growing so fast right now, just like search just like there used to be dozens of search companies that were all doing well, right, for a while. Now there's one. And that was really Google. It's just, I don't see it being a long-term thing to stay into. Olga says, I didn't buy LB initially as a new position. Would you just sell the put you mentioned to begin with? Yeah, absolutely. I think that puts a no-brainer to me. That's the what was that? The $35 put for $5, or the $30 put for $5? What was it? LB. Now I totally forgot what it was. It's the 2020 $30 put. So you're selling the 2020 $30 put for $5 or $5.20 or whatever it was. You're netting in for $25, let's say. It's a $34 stock. It's a $9 discount, so you're getting 30% off. Is your worst case. Your best case is you make $5, and the margin on that, if we sell, if you sell 10 of them as a standalone trade for $5, your margin is $2,500. So you collect $5,000 against $2,500 in margin. So it's margin efficient. So you're gonna make 200% of your margin as a profit. I mean, what else are you gonna do with money if you can't do that? And May says, thanks. Fed minutes. Oh, thanks. Thank you, Brendan. Good point. That's an important thing. Let's take a look at the Fed minutes and see how we're doing. Well, let's take a look at the charts and see what they're doing. Oh, I forgot my short. Damn it. I guess the Fed minutes were encouraging. They're sticking with the gradual rate hike path, according to CNBC. Oh, son of a bitch. Didn't I have to, I have 2 NQ shorts? Anger. Ow! I did not mean to keep those on for the Fed minutes. Oh, well. All right. This is good, though. It's okay. I would love to get back to 60. See, that now at this point, now that I'm stuck in these, I'm hoping we get back to 69.40 so I can short again. Because obviously the Fed minutes aren't going to change anything. Fed rates could be above neutral. Another hike if the economy is on track. Just reading what they say on CNBC. Some support for modifying accommodation. Oh, I see. Okay, so there's more and more people who are thinking that they want to keep it easier for longer. So that's the gist of what's going on now. All right, but the Fed speakers have already been strongly indicating that. As I said last week, I said, how could these guys get any more dovish? I mean, they constantly are making more and more dovish comments. So I'm going to allow these losses to wash in. I'm at 6,900. If I go to 6,940, my average will be 6,920, which is right here where we are. So that's kind of my plan, but I don't think we're going to get to 6,940. I'm just going to keep an eye. Watch the Dow. If the Dow goes over 24.8, then this guy will certainly go higher. The S&P 27.28 we know is where we're probably going to get rejected, so that's where I would definitely start adding some shorts. Now, obviously say, well, Phil, you got two here. You think it's going to go higher. Why not take the loss and wait? And honestly, though, because it still could pull back. So it's really not worth it for me right now, because taking the loss here isn't going to make much of a difference on the whole. I'm going to add two more at 69.40, which is up here. Whoa, way up here. So if it gets up here, I'm certainly going to add. But I strongly believe the S&P will stop at 27.28, because that's significant resistance. That's our strong bounce line off the 20% line. And so I can sort of extrapolate that if you're going to go to this, you're going to go to the pink line here. That means you're going to stop at this line here, which is what, 44. It means you're going to go to the pink line here if all goes well, but I don't think it will for the Dow. I mean, is the Dow going to go up another 100 points? And if it does, I could buy two longs here and make all the money back. So that's interesting because, yeah, if he breaks up, it might make sense to go long on the Dow with a tight stop at 24.8, because then I could offset my loss on the NASDAQ. So let's see, but I'm not sure if we really have it in us to break over these levels. I want to see 25 over here before I go long on the Dow. It's going to go past it, though. It's annoying. 24. See, it's having trouble at 25, which it shouldn't. If it's really going to be bullish, you shouldn't be having trouble here. So the Dow stopped at 24.8. You're stopping at 27.25. The S&P, the Nasdaq, the Russell's at 27.30. So whatever the Nasdaq is now is where I got to start to hit the short. So now I have a better plan. I'm going to short now. 1, 2. And if I go over 24.8, though, I'm going to go long to offset the loss on the NASDAQ. But I've raised my basis now to 69.15. None of the other guys are as appealing to short as the NASDAQ is at the moment. Because what did the Fed say that would make the NASDAQ go higher? What did they say that's going to benefit Apple or anybody else? First of all, the tech companies don't even borrow. Right? Think about it. They don't even borrow money. They've all got tons of cash. So they don't give a shit what rates are. So anyway, so that's why I would rather double down and raise my basis than sell. I mean, you could do both. It wouldn't matter. But mechanically, I just prefer to double down, have a higher basis, and then I'm going to get back out and lighten up again when I get back down to my goal. But right now, everything happened. I basically hit it on the nose while I was prevaricating about what I was going to do. And as I said, though, that shouldn't have been having trouble there. If it's really going to go higher, why would that stop you? This arbitrary line right here. And if you're really going higher, why would this line stop you? What is it about that line that makes you want to stop? Nothing. So therefore, it becomes dubious as to whether we're going higher or not. Now, I've already picked up a good amount of money off this, so I could lighten up here, but I don't want to. I'm going to see now. I'm watching closely to see if the momentum continues to the downside. But if I'm losing it, then I want to lighten back up and see what happens. So 24. So let's say I'll make 25 my stop now. Oop, but here we go down to 21. So 22. Now he's obviously going to bounce off this pink line. So unless the other guys are completely crashing. Ooh, GE CEO says he can't guarantee the 2019 dividend. That's a nice contrary to the Fed. Bitcoin drops to the lowest level back below $8,000. Lowest level of the year, I guess. Oh, 622. Because you know he's going to bounce off this pink line, so probably I should lighten up here. Ah, that wasn't nice. 22, 22, 25. Because what I've done is now we're down to minus 500. I've knocked off half my loss. Ow, you son of a bitch. 23. Ugh. Next time I hit 22, I damn well better take the money, right? Here it comes. Tease. All right, you know what? I'm going to actually put a buy in there. Ooh, that didn't help. He wants me to chase it. Oh, you bastard. Look at that. Forget it. I withdraw my buy. That made them bold. He suddenly decides to jump up. 20. Oh, shit. Back down 1,000. See? That was stupid. Unbelievable. See, the idea when you do it is to lighten up and get back down. So I could have easily doubled down again when I did that pop. Now I'm just stuck watching it. Holy crap! Look what the Dow did. It just blew over that line. Oh no! I'm sorry. Yeah, well the Dow was down here. It just blew right back up to this. It's incredible. And what I say, I should go long on the Dow. I didn't feel like going long on the Dow, but I guess I have to. If the Dow's popping this line, I got to go long. But it's the same thing. Now we're back to where I was when I was saying I wanted to add the 2. But he's not making the same high. It was so obvious it was going to bounce off this pink line. So they should have just taken that money. See, I don't have any conviction. Otherwise, I would do more and I would change it more. But I don't know which way it's going to definitely go. So let's see if we can find those Fed minutes and read it and see what it says. Actually, you know what? Let's look at the Wall Street Journal. Let them tell us what it says because it's going to be faster. No, you guys are busy. Oh, wrong thing. Comcast, Deutsche Bank, Fed minutes. Here you go. Fed Reserve likely to raise, and of course Jackie's not a member. Sign in. Oh, come on. I had this one for so long. It's an old password. Yes, save it. All right. Fed minute signal rate. All right. May minute say would likely be appropriate for another rate rise. Okay, but then you have to weigh into the fact what kind of data came in since then. Fed officials signaled they've raised the benchmark rate. If the economy performs expected, it's likely to be appropriate for the committee to take another step. The Fed benchmark rate held steady at the May meeting. So that means very soon they're going to make another hike. Officials said the continued rate, more to come. So they're updated. Okay. The May continued interest rate increases could leave the rate at or above the estimates of its normal level before too long. The hell's that mean? Officials said continued interest rate increases could leave the benchmark rate at or above their estimate of its longer run normal level before too long. Wow, that's a weird and vague sort of thing to say. No wonder the markets are confused. Okay, I'm confused too. What happened? Oh, nope, still floating around. So it's not enough to get us over the hump, and we know that this at 28 over here is going to be significant resistance. So I'm certainly more inclined to stay short than anything else because we're just going to pump up to here and fail. And the Nasdaq, of course, got way too excited. That's like almost 100. That's a 100-point move in the Nasdaq in one day. That's completely not valid. I mean, obviously, it's not coming through. It's coming through as a 20-point move because it was down. It was down so much, and now it came back. But 100 points up since the open is crazy. Since the open basically. So it's a wonderful short right now, especially if you start here instead of starting at 15 where I started. Actually, I didn't even start there. I started at 6,900 before. But I am very confident we'll get back down to 20 at least, and hopefully 15. So that's what I want to do. We'll just wait it out at this point. Okay, so let's see what else is going on. So John says, if we have FOMC minutes happening right about now, and we're expecting some kind of move, would placing a straddle on the SPY be a decent play? And so by a straddle on the SPY, he means just bet on it in either direction. And if it blows up one way or the other, you're gonna make money. And it's fine to do that. Obviously, it's fine to do that if the move you expect is more than the amount of the straddle, which you have to look realistically and how much of a move do you usually get? What kind of thing do you usually get off the Fed? 100 points is too much. See, my attitude is I'd rather wait and see who has an overreaction, like the Nasdaq, and then short the thing that has an overreaction, or go long the thing that has an overreaction if everything had collapsed. That's what I would do. That's how I prefer to play it. So GE CEO says dividend risk. I don't really see. For me, dividend at risk is not a big deal. Oh, here we go, 22. What did I say last time? I totally regretted not doing this, right? So, I gotta stop doing these webinars. Son of a bitch. Instead of like watching it, I freaking let it go. Unbelievable. All right, we'll wait. I'm patient. I'm not chasing you. Anyway, dividends. So I don't care if my company doesn't pay dividends to strengthen themselves, because dividends are stupid, okay? I don't need GE's 25 cents. I want GE to do better. GE is going to make me a lot more money getting back to the 20s than it's going to make me by paying me a freaking little teeny dividend, all right? And this is something people don't understand about many, many stocks, okay? So GE, so I like dividend stocks that pay 5-6% because at least you have the stream of money coming in. It's nice to have. And plus, because we sell options, we turn them into 15-20% returns. So I don't mind that. I mean, it's not a bad way. It's a good place to park money. But GE is paying a 48-cent dividend. So 4% gain in the stock is more. They lost, anyways, look what they lost today. They lost $1.14. 1% is 14 cents, 3. So really like a 3%. It's about a 3%, 3.5% move in the stock is more for me than the dividend. So if you're only in it for the dividend and you're just living to collect the coupon, then you care about the dividend. But if you're not, if you're investing in the stock because you think it's cheap, I say screw the dividend, people. Keep the goddamn money, because look at how much money it is. Balance sheet. Not balance sheet, cash flow, sorry. Cash flow. Dividends, $8.6 billion. $8.6 $8.6 billion was paid out by GE in dividends. They only made, wait. They didn't make anything, but they only make $8 billion in a good year. So half of the money they make is dividends. So why do I want them to pay a dividend? What is the benefit for them paying a dividend? How does it help me to get 50 cents when they could have double the earnings? And if they had $16 billion in profit instead of $8 billion in profit, and you give them even a 10 PE, they'd have a $160 billion market cap instead of a $122 billion market cap. So 30% more is going to be $5 more in the stock price. So would I rather have $5 more paid in my stock as the stock price goes up, or would I rather collect a 5% dividend or a 3% dividend? Dividends don't do you any good unless you're a dividend investor who only cares about getting those little dividend checks. But as a person who owns a company, who owns a stock and wants the stock to do better, money is better than dividends. Now, Apple makes so much money they pay a dividend too. Apple doesn't know what to do with their money. But if GE has something better to do with their money, like invest in something or buy another company or do something else, then paying the dividend is a foolish waste of money, as are stock buybacks. But dividends are even worse than stock buybacks. Okay. Jim says the NYSE is not budging. So the bottom line on the dividend, I don't care. I'm happy. When a company cuts a dividend, that's like the time when I like to go in and buy more. Because I'm like, thank you. You've seen the light, you cut your dividend. All right, it's like, good. Don't bring it back, or don't bring it back anytime soon. Like FTR cut their dividend, and we went gung ho in on FTR because like, great, they cut their dividend. Now they're not paying out all their freaking profits in cash. People went ape shit when they cut their dividend. It was a hell of a dividend too. When did that happen though? Somewhere, I mean, they somewhere around here. I don't know. They started. They were talking. They cut it back, and then they cut it completely. I think it was here. They cut the dividend completely, and all the people who love dividends sold and dropped the thing 50%. Then people started coming back in, and now it's sort of settling in closer to where it started before they cut the dividend completely. I don't care if they pay a dividend or not. I want them to go back to $30. If the dividend is stopping them from going to $30, then stop paying the dividend. The NYSE is not budging. Well, nothing's budging, really. I mean, we're flat. All we're doing is struggling to get back to flat. So I'm not looking specifically at the NYSE. Oh, wait, I can do that in a stock chart. So I think that'll tell me today's move. Oh, I see what you mean. It's not even really coming off the floor from where it started today. Wow, that's pretty sad. But still, it's off the lows. So, I mean, technically, I mean, the futures opened it down. It's still way down. So how much is that? It's down 50 points. And the Dow is now down only 15 points. Uh-oh. Look. Hitting 24.8. I said I was going to go long on the Dow if it went over. How's my NASDAQ? 29, 30. Okay, I can add a couple more here. 31. Come on. I think somebody's watching this webinar who's controlling this thing. I'm adding one more just out of spite. All right, there we go. So now I'm up to 18. I'd like to get up to 20. So now I have to do math. So 5, I need 5 to go up 2. So that means I need 10 more points. So I have to be at least 28, but I really need 30. So I have to be at 30 to hit my goal. Otherwise, so I have to do 30. So I need 1 at 30. That's going to, and the rest, and since I have extra, I can give an extra 2 to 5 other positions, right? And that brings me to 20 as an average for everyone. That's how you do it. I mean, that's how I do it. This might be a confusing way to do it. But basically, when you're looking at it, I have 5. I want to bring those 5 up 2 points, right? So that means I have to be at least 10 points over that number, 28. But being at 28 doesn't help, because if I sell at 28, then the 6th one is going to get pulled down by the other 5. So I have to then have an extra 2 points for the 6th one, so it can take the drag. So at the moment I'll leave it, but the problem was last time I wasn't quite getting even when it got down to 20, so I was disinclined to pull it out. So hopefully we can get another little pop. What's this? Now I'm shooting for, what am I shooting for? I'm shooting for 35. That was where it topped out. So it only topped out for a second. So anything around 32.50, I should really add another one if I can. So right here is going to be my goal. But, or of course, if it drops back down, then I'm just going to take the money back and be done. See, so it briefly spiked over, and that's why you can't just say the second something goes over, you do it. You want to see a serious candle form over the line. See that? So the line being 802, wait, 800. There's the line right there. There's been no serious formation of a candle, just these little spikes over the 8 line. And these are what, 5 minutes, I imagine? 5 minutes, yeah. So these are 5-minute lines. So there hasn't been a 5-minute period where this thing has held the line. So that's not bullish. Just because it spikes over for 2 seconds, you can't go running in and out of positions based on that. So when I say I'm stopping out after I see a significant break above my point, not at the point, not the second it goes out. Otherwise, you'll never stay in anything. Especially on the futures, because they can see. They have programs. I don't know how they do it exactly, but they can see your stop. Like they ping all these things, and there's some way that they have it. You're exposed when you put a stop in. So when you put this order in, that's why sometimes you put an order and you see the thing flying away from your order, and you're like, what the frick? It's like, what do I do? It can see what you're doing. They're constantly pinging, and as soon as an order goes in there, they're in a better position than you are. They have faster lines that are closer to the exchanges, and amazingly for these robots, that matters. You know, it's going at the speed of light, but it doesn't matter if it's going at the speed of light. They got half the distance on you, and they can react that quickly. So when you put your order in, as soon as it shows up on the exchange, they cancel their order and then push above your order in order to force you to chase it. And these are not people trading. That's the problem. These are robots trading. And they're trading. They're thrilled to make 1 point off you. This one tick over here, a robot will take that money and run. That's what they're doing. They're trading millions and millions and millions of times a day, getting 1/10 of a cent every time. And that's fine with them. That's what they're there to do. There's a lot of these firms that run these bots 24/7, and they make $10 million, $20 million, $30 million doing it. They're fine. That's all they want to do. They got $100 million fund. They make $30 million bucks, and it's great. And all they're doing is running these algos over and over and over again to nickel and dime people to death. They're not gambling. It's the same thing, though. They're not gambling. They're being the house. They're watching you trade, and they're taking your money every time. So, you can't react to every little move and every little spike, because half of it is fake. Not even half of it. 80% of it is fake. And you just have to wait until you have a chance to get in there. It's easier on the Russell. That's why I like trading the Russell. See this? This shows you bids and asks, right? You can see how heavy the trading is. On the Nasdaq, unfortunately, they don't show the same thing. So you're flying blind. You get it on the Dow, but you don't get it on the S&P. It really annoys me with Thinkorswim, unfortunately. Now, someone had a question. How do you add the pivot lines in Thinkorswim futures, John says. And John, it's very simple. All you do is you go to the right. You go to the right. You click on the chart, then you right click, and then you go to studies. No, not studies. I'm sorry. Wait. It's a study. Add a study. Sorry, it is studies. Add a study, and it's a trend study. And then you go to P, and it says down there, see pivot points, and you just add the pivot point study, and that's it. You have to do it, unfortunately, manually to each chart, and then you have to save. Then if you go up here in Thinkorswim to set up, you want to save your workspace after you do it. Otherwise, you have to do it again next time you come in. So you always want to save your, if you have the workspace set up the way you like it, you want to save it in Thinkorswim. And you save your workspace as and give it a name, and that way you can always open it back up the way it's supposed to be. Also, for the chart itself, if you right-click on the chart and you go to Style, and it says Save Your Chart Style, you also want to do that. You want to save the style of your chart once you're happy with it, so you can, then you can always add, then you can always revert to that chart style on each chart you make. And for me, I like the 3-day, 5-minute charts, and then with this one study is the only study I have. It's the only study I find useful, really. It's these pivot points are actually very, very good, because all they're doing is showing, based on the recent trend, this is what the extrapolated trend looks like for the day. That's all they're doing. They're just showing the standard deviations around where the trend has been going. So it's super useful. And the most useful thing about it, though, is because since it's very standard, and so since it's very standard, you know that the trading robots are going to be set to react to these lines. This is where they're set for. They're being told, if you go over this line, then do this. If you don't go over this line, then do this. So when it gets to this line and it doesn't go over, the trading bot starts selling. That's an activation of their program. Then it goes back up, and then the trading bots activate again and sell off again. Now you get to the bottom, and people and the trading bot not the same trading bot, other trading bots. There are bullish trading bots, there are bearish trading bots, there are neutral trading bots, and they're all sort of cross-firing with each other. And that's what the 5% rule is about. The 5% rule says all these robots doing all these things based on all these algorithms end up meeting at certain intersections. And those intersections tend to be at 5% variables. And when I say 5%, though, it's 5%, 10%. It's also 2.5%, 1.25%, 0.625%, or whatever it is, or 6.2, whatever it is. It's each part in between also, but they tend to move in 5% increments because they're robots. That's why they do that. So that's all there is to it. And then you can calculate what things are going to do based on that. And in fact, this morning, we were calculating. And what did we say? I went through it with one of these. Oh, so 2,700 on the S&P is still bouncy. And we never quite hit it. So call 2740 to 2705. Okay, so the weak bounce is based on the 5% rule. All right, well, what do we mean by it? 2700 is the bouncy line. We didn't hit it, and then we went from 2740 to 2705 because I said we never hit it, so we're going to call 2705 the bottom because we never made it to 2700. That means it's 35 points drop. So if you have a 35-point drop, your bounce is 20% of the drop, so it's 7 points, and that means 7 points above 2705, the bottom, is set. 2712 is the weak bounce, and the strong bounce will be another 7 points, 2719. So what we predicted at 9:43 this morning was that 2712 and 2719 would be a significant resistance points on the S&P. So now we go back to ES, and we see what actually happened. And we went up, and here's the 2712 line, and you can see how it quickly became a floor. See what happened? We got over it, and then it kind of held up as a floor, which means you're almost certainly going to go and test 2719. Then we get back up to 2719. And again, like I said, it's not an exact science. I made this whole freaking rule up, so it's certainly not exact science. But the point is that it didn't really go much over our expectations, and it came right back down. So 2719 turns out to be a good predictor, and we didn't pop it until a catalyst came, the Fed minutes, that caused us to pop it, but those Fed minutes aren't really that bullish, and so we're probably going to settle back down, at least back to the strong bounce line. Now, if we're going to settle back to this strong bounce line here, which is where we topped out before the Fed, then I would expect everyone to come back to where they topped out before the Fed, which is here for the Dow. And, well, interestingly, the Russell topped out much higher before the Fed. And here for the NASDAQ really topped out about here. So I should still get a nice pullback on the NASDAQ. It should come down. So, and now if you say, well, that seems pretty far, that's not too realistic, I at least should get back to my 6,900 then. But remember what I said? Look, not going to miss it this time. So now I went from 5 to 3. I'm down 370 for the day. This is wrong now because the ones that I have now are up 550, but that doesn't help my overall. I was down more, so I'm only up 370 for the day. But now I'm down to 3 shorts, and I only have to make up 370. That's what you call scaling in and scaling out. I scaled in, raised my basis, and now I'm going to start scaling out to get my basis to a lower point. So when we started, it was 6,900. Now 69. Well, like I said, that's not real. Now probably 69.20 is my break-even point. And you see at each end, I'm watching and I wait and I say, is this real? Should I panic out? And I think, it's not should I panic out, yes or no. It's should I panic out or should I add more because I doubt that I'll be hurt more than I'll be helped. And make no mistake about it, you can get really burned on this. It can keep going against you in a huge rally, and now you've doubled down, and it's getting worse and worse and worse. So you have to be able to laugh off losing thousands of dollars to play this way. Otherwise, you should be playing only with tight stops in the futures. But if you have a lot of money, if you could go to a craps table and put $1,000 on a craps table on a roll of a dice and go, oops, didn't make it, and then walk away and go have a nice dinner, then you can play this way. But don't play this way if it's over your head, because you can get burned and hurt really badly, and you cannot make it up if you get hurt really badly in this kind of stuff. It's not like you can sit there and go right back at it, because it's a lot of margin, a lot of risk, and so on and so forth. If God forbid I lose $50,000, I'm going to trade tomorrow, and I won't trade $50,000 trying to make it. I'll trade to get $5,000 back for the next 10 days and be really careful about my trading. But I can take a $50,000 hit because I consistently make $2,000, $3,000, $4,000 a day. So if I have one bad day where I took a chance and it didn't work out, all it does is set me back a week or two of earnings. And does that happen? Yeah, it happens a couple of times a year. I'll take a big hit on something. But mostly it works. And mostly I grind out my $2,000 and $3,000, $4,000 wins. So over the course of a year, I'm up 500,000. Maybe I'm down 100,000 on bad losses, and I'm down another, $100,000 on normal size losses. But then overall, I'm going to make about $200,000 a year trading. I average $1,000 a day profit, so that's fine. Could I trade harder? I could, but I don't like the risk. I have 2 daughters going into college, okay? I don't like losing a semester of college, even though it's all paid for and whatever. I don't like losing a car. I don't know. I never get that. I don't care how rich you are. I do know guys who gamble like that. I don't know. I don't care how rich you are. I don't know how you can walk away when you lose $100,000 and not be pissed. I'm not rich enough not to be pissed if I lose that kind of money, so I try not to. And I'm not saying I laugh off a $50,000 loss, but if I lose $50,000, I have a clear plan to get it back pretty quickly. But that's the level of trading I'm at. Don't trade above your level. If you lose $50,000 and you're wiped out, and you're saying, "Oh my God, now how am I going to be able to afford, to eat or whatever?" Or there goes my mortgage payment. You're gambling way too much. When you lose, you should be losing something insignificant. Like for me, whenever I lose, I always try to make it up immediately with something I don't do. So, like if I'm buying my daughter a car, I'm planning on buying her a $30,000 car when she goes to college. But if I lose $50,000, on a trade and I don't make it back by the time I go to buy her a car, then I'm going to buy her a $15,000 car. And I'm going to make back my $15,000. Sucks for her, but that's why I never tell her when I'm going to do something like that, because you never know. When you're trading, you never know whether you're going to be hot or not. So it's like I plan to do something nice, but then I like change my plan. Or for the family, like if I have a good week, I might decide to get all first class tickets to like go, on a trip, which cost a fortune, but what the hell, I had a great week. If I have a bad week, I'm like, we're flying coach, And in fact, we're not even taking that trip. We're going to cancel that trip. We're going to go drive to the shore, and I'll save $10,000 that way. The point is, it's gambling within. You got to gamble within your means. You can't let yourself go crazy. It's not the lottery. If you gamble sensibly, if you play sensibly, you can make really good, consistent money doing this stuff. But once you start overdoing it, you can get killed. So that's the point. So what I'm doing when I do these scaling in, when I start adding to a position I'm losing, I'm being aggressive. But I don't. I hate to say this because it's like a bad thing to say. But I mean, I don't care if I'm down $1,000. I spent $1,000 on restaurants this week, so all I have to do is not eat out next week, and we'll be fine. It's just, I'm saying it's within the means of what I have. That doesn't change my lifestyle one bit, other than, instead of going to a steakhouse, I'm going to go to McDonald's. You shouldn't gamble where it has more of an effect than that on your lifestyle. So basically, it's just, first of all, it's just not for you if you can't afford that kind of stuff. Second of all, though, there's two ways to play. You can play with very tight stops, which is what anybody who can't afford to lose that $1,000 has to do in the futures. You have to play with very tight stops and only play like when when something's really topping out, you take the trade, and let's say, where I double down. Let's say if you came in at 32.50 and you say, well, at 35, which is 2.5 away, I'm going to be down 20 times 2.5. I'd be down on the NASDAQ, you'd be down $50 per contract. So you say, okay, I can afford to lose $50 a contract. I can afford to lose $100 a contract. You could widen your stop. But first of all, you shouldn't even be risking 100. And that's another rule of thumb. If you don't think you're going to make 200, don't risk 100. If you don't think you're going to make 100, don't risk 50. You've got to firmly believe you're going to make a lot more than you're going to lose. And it goes back to that same risk reward. It's like always put yourself in positive risk reward situations so that the reward is going to outweigh the risk. That way you don't have to be right 150. Even if you're not right all the time, you're still going to make money. And that's what we do with our options as well. So Sri says, thank you. Okay, that doesn't help. What about May says, what about the NYSE levels? Are you still negative on them? I'm not negative on them. They're negative. So, it's not me. I'm not picking on them or anything. What do we say about, was that in today's the morning thingy? Yeah, it was. Okay, look, there's a line on the NYSE. And on our big chart, which I think is down here, yes, thank you. Yes, thank you, Jean-Luc. The NYSE, the must-hold line on the NYSE, the only index that's red, which is the broadest index, it includes everything. The broad index of the NYSE, the must-hold line is 12.8, and it's not holding it. These guys are all off to the races, but these are all very narrow indexes by comparison. This has 3,000 stocks or so, or 5,000, 4,000, some large number. Let's say 3,500. The Russell has 2,000. Okay, but they're all small cap. The Nasdaq has 2,000 in the broad Nasdaq and only 100 in the Nasdaq 100. S&P 500, of course, and the Dow has 30. 30 stocks doesn't tell you crap. Doesn't mean a thing. The NASDAQ is 20% Apple. So all this does is tell you how Apple is doing. The S&P is a bit more reliable, and it's up 20%. So it's up 20%. The NYSE is 0, is flat. So what that means is that the big cap company is doing very, very well. The Russell is only up a bit more than 10%, like 15% over its line. So the Russell is not as up as the S&P is at 1625. There's a 10% line. So the 15% line would be, well, actually quite a bit higher. There'd be more like 40. So like 1650-ish would be the Russell's 15% line. Still way behind the S&P and the MY and the Dow. Like I said, the Dow doesn't matter what the Dow is because any one or two companies like Boeing and Apple's in the Dow too. They drag it up. The NASDAQ, all Apple. The S&P, Apple again, but also other big cap companies. And here's the thing: if the market has a high multiple, then the big caps are going to multiply higher and have more of an effect. So the bigger your market cap, and when you apply a higher multiple to the earnings, you're going to expand those market caps more. The bigger the market cap is, it's going to give you a bigger result in the index. So that's bloating the S&P. The NYSE is basically the people. That's everybody. No single stock has any real impact on the NYSE. It's so many stocks. The Russell, because they're small caps, again, because they're small caps, they're heavily affected by inflows of money and such. So they don't give you a really good reading too. But the NYSE, that's everything. It's not going to be affected a lot by any single factor like money flow or anything like that. It's really giving you a true look at what the market is. And unfortunately, the market is at 12.8, is the must-hold line. So if the NYSE can't even get above that, when you've got this index and this index and this index are all up over 20%, and the Russell's up 15%, almost or 12%, this guy's flat. And flat is bad. Below flat, not good. So the NYSE is telling us there's a problem. David says, have we talked about GE? Yes, we have. I'm happy they halted their dividend because I'd rather have them have money than give it away. I wonder what you think about the CFO comment in the conference. If you talked about it, please ignore my question. It's fine. No, basically, I said, look, with dividend-paying companies like that, GE makes $8 billion in a good year, and they pay an $8 billion dividend. That leaves them with zero. I like them to have the $8 billion so they can do stuff. So instead of having to sell off a division or make a deal, they say, hey, we've got $8 billion in cash. Let's use that. So I'm happy they're finally cutting their dividend. I think it's a good idea. and it's a funny thing because, like, all right, again, GE is a $120 billion company. They pay an $8 billion dividend. That's 7% of their total market cap. Okay, so that's like if I'm a millionaire, I have $1 million in total assets. That's my market cap, right? And I have $100,000 a year salary, but I give $100,000 to my kids as an allowance, which they don't need. It's excessive. And I have nothing to spend at the end of the year. Nothing left. So I got $1 million in the bank, or $1 million in cash and assets. I made $100,000 this year, but I gave it all to my kids, and they spent it on who cares what. And I have nothing to show for it. So I worked a year and did nothing. My assets didn't grow, nothing changed. I just wasted a year. That's what GE does every time they give out the dividends. They did nothing. You don't work to give all the money to your shareholders. A lot of companies, they fall into this trap and turn into dividend-paying companies, and that's it. They're done. And GE had become a gigantic conglomerate before the crash in 2008. They became a massive, massive company with tons of divisions and all this crap that was too bloated and too crazy, and they weren't even growing because they were still paying out these crazy, because they also became a dividend stock. After the crash, they trimmed themselves down, but the mistake they made was they kept paying these idiotic dividends. So now they're a smaller company paying all of their earnings out in dividends. They're like a REIT. REITs don't grow. There's no growth in the stock. So I don't want them to be a REIT. There are REITs. If I want to invest in a REIT, I buy a REIT or an LLP pipeline company, something like that. If I want to get all the profits sent to me in a dividend. I want GE to grow. I want them to build solar farms. I want them to get into renewable energy projects. I want them to do transportation infrastructure. That's what I want GE to be doing. I want them to do massive projects when governments decide to spend money and bring in hundreds of millions of dollars and make $10 million more in profit. That's what I want GE to do, not just sit there and spin their wheels and pay out dividends. It's a terrible way to run a company. So I love it when companies cut their dividends and everybody runs away from them, and then I start buying because I'm like, good, now you're gonna have cash. So that was my short take on GE. How are we doing? All right, so now we're going back up, but I don't really care now. I mean, I'm down $800 still, but I don't care because I'm happy to add more now. I'm going to raise my basis higher more effectively because now I only have 3 stocks that I'm going to be raising the basis on. So meanwhile, we're still under the line here, still under the line here. The Russell is weak. The Russell hasn't even recovered to where it was before the Fed minutes. So on the whole, I've got no reason to change my mind on this. The NASDAQ is stubbornly high. I guess probably if we look at Apple, we'll get a clue as to what's going on. Yeah, here you go. Because Apple is up from 185 to 187.50, so that's 2.5 into 185 is what, 1.5%? So the Apple's up 1.5% from the bottom. And the NASDAQ is up, I don't know where it would be. All right, so from the bottom, it's up 40 to 30, it's up 90 divided by 68.40. So let's see. 90 divided by 68.40, 1.3%. So the S&P is up 1.3% from the bottom, which is basically the same as Apple's move. It's just doing what Apple's doing. I'm sorry, that's the NASDAQ. So now I have to say to myself, now if I'm going to bet against the NASDAQ, I got to look at Apple and say, is Apple going to go much higher? And I don't think so. I don't see any particular reason. There certainly is nothing the Fed said that should make Apple go higher. They're the last people in line to borrow money. In fact, if anything, they would rather get more interest on the money they got. So I think that we're going to probably be about done over here, which is where Apple's topping back out where it was before. We got the resistance line on the Dow, where they're being a loser, and then we were looking at what that's the S&P down there. Then we go back to YM. Oh, we should look at the dollar too. So that's below that. Then DX dollar, and he's come down, which helped the market pop from the Fed announcement. Dollar went down because the Fed's going to be easier, so there's going to be more dollars floating around. But now people are reading it and saying, you know what, that's not really what they're saying, and we'll stay probably the dollar's basically as long as the dollar stops falling, then we stop readjusting to it. So about 250, I would like to add another one. But that's the unfortunate. I can no longer rely on any of these numbers because now once you start breaking it up, it screws think or swim up completely. The only number you can count on is that number is real. So then I can have to back calculate where I am. Oh, here we go. All right. I'm going to add one there because I'm not sure it's going to stay. So now I'm back to being down $1,000. I've got 4. I'm going to go for 5. 35, I guess. Now I'm trying to figure out how much I'm down. If I'm down $1,000, that means I'm down. It's $5. So it's 20 times 5. So on 5 shares, $1,000 is down 20 points. So that means I'm at 15 roughly. 69. That doesn't seem right. If I have 5 of these, then $25 a point. Oh no, I'm sorry. It's 250 per. I'm sorry. It's 250. That's why. It's 250 a point. So it's only 4 points below. So 31. So actually, 31 is basically my break even. That's what it says. That's funny. Okay, so 31 is. Wait. No, that can't be right. Why can't I do this math? The Russell pays $50 per point on a contract. So 1 point is here. That should be $50. And that means each of these should be, okay, so $50 per point. So it should be $250 for 5 contracts. Oh well. Too complicated. Wow, it's really going against me here. So 250, 1340 down now. So let's watch it tick. 215. Oh, it's going too fast. 1140. 1140 at 30. 1140 here. 1190. So 50 cents is only changing it by $50. It's not moving as much as I thought it would. I gotta check the prices on these Russells. 4x. There's something wrong with their calc. Yeah, there you go. So it's $5 per tenth, which means it should be $50 per point. There's something wrong there. Oh, it's not TF. It's RTY. Nope, still $5 a tick. Weird. I don't know if anyone knows why that is. I'd like to have it explained to me because that's weird. Because if it's $5 a tick per tenth, then it should be $50 per point. If it's $50 a point, and I've got 5 contracts, it should be $250 a point. So here's 38. Here's 38.50. So that should have been $250 right there, or $500 change, but it wasn't. So in no way is that reflected. Right? I'm not crazy. It should be $250 for each point. Here's 37, and it's 1,400. So 1,440, and it should be like $125 difference for each thing. 14. It's not reflecting the number that you would expect it to be. Very weird. Okay, I don't know why that's happening. Meanwhile, though, I'm getting burned because here we're above 24.8, where I said we should go long on the Dow to offset the loss over here. I didn't do that. Now we're up to 20, but the point is we're up to 27.28 on the S&P, which is a strong bounce line. We said there's no way that's going to go over. So that's the point at which I want to add another contract, because this is where I think we're going to stop. But we're clearly not stopping, so fortunately I didn't add it yet. I want to see that getting rejected. I'm going to do it though. Here you go. Might not get another shot at that. So I'm expecting a failure at this line. And if I don't get it, I'm going to get burned. I'm down $2,000 now. Anyone see a reason for this? Is there any kind of anything going on narrative-wise that I should be paying attention to? I mean, that's just an ES short. Now, well, it doesn't matter if I short the ES or I short the Russell, but I mean, it does matter, obviously. The Russell's taken off. But yeah, the ES short would work too because 27.28 is where we expect to get a pullback. And maybe I'm missing something because I don't see anything all that exciting going on that these things should be popping on us. So the bottom line is I'm going to hold this and see what happens, and I'll see if we go over 50, I'll be a little bit concerned. I'll be very concerned actually. If we go over 50, I think if we go over 50, I'll probably cut it back. And I'll take a loss. I'll take a $2,000 loss and I'll just make it up somewhere else. But I don't see why we're doing this. So take a look on Seeking Alpha and see if it says anything. News. June hike a go. How is that a thing? GE no growth. Biotech's rally with a house. Oh, biotechs are probably helping the Russell a lot. That's why. Ralph Lauren, new home sales drop. Google passes Amazon smart speaker sales. Jaguar Land Rover spending out. Well, that's good. Oil firms rush into North Sea blocks. Transformational light. That's a market mover. The North Sea Sport transformational licensing. 61 companies. Oil. Okay, is a big. That pushes a whole sector because you got here. That's probably where the big push is coming from. The North Sea, obviously, it's going to be it's good for the drillers, it's good for the platform companies, it's good for the shipping companies. There's a lot of people who benefit from this. Is a massive pending infrastructure spend on that. Apple Watch shipments up 35%. No wonder Apple's flying up. Holy crap! See, that's so weird. Like the Apple Watch, I don't know anybody who has one. I mean, I've seen people wearing them, but I mean, none of my friends have Apple Watches. It's just a weird thing. But I think they're very popular in other parts of the world, I think. And maybe I need friends who move around more and use the sporty parts. Chipotle moved to Southern California. Who cares? Senate antitrust. Nope. Who cares? Feminist June hike. We know that. Disney ABC is exiting. Who cares? Ackman, this is the stupidest thing. Lowe's is up 10% because Bill Ackman is coming in. That guy's poison. They're nuts. Credit Suisse defends advanced order. French unemployment edges up. Who cares? Curtis Telefonica. German American Bancorp. Who cares? ESPN confirms deals. Okay. Twitter rolls out election labels for midterms. Who cares? Paddy Power, who cares? All right, well, obviously nothing really going on. So the thing that's really going on in this North Sea thing is very, very significant. I wonder if that's going to lower the price of oil, though. Let's see what oil's doing on that. Yikes. Oh, here we are. If this pink line breaks, I'm going to have to lighten up on these guys. But now, here's the thing. If I'm going to have to lighten up above that red line, then there's no sense in not adding while we're still below it, because I can't lose much on the new items, right? So if it goes down, I'll make a lot more. If it goes up, I'm just going to get out. So what's the difference? So once you get to the line where you say, okay, at that point I'm going to stop, it doesn't make sense not to add. But you've got to make the stop, otherwise you're way overcommitted. So now the question is, if we pull back, what's going to make me happy? So P&L from the open is the thing I care about. Is $1,000, because that's what no, I'm sorry. P&L for the day is what I care about. $2,000. So the question is, am I going to take $1,000 and be happy, or at least lighten up at $1,000? I think I will. because it has not been going my way. So I should be thrilled to cut my loss to $1,000 and then keep a smaller amount at a higher strike, of course. So what I'm looking for now is anybody breaking higher, or are we calming down now that we've hit 27.28? And unfortunately, we're going to have to cut the webinar, apparently. It's time to end it. But so my plan is basically I'm going to lighten up. Either way, over this line, I'm going to lighten up to at least 4. Probably I'll keep four short and go to sleep on that and then hope they don't go too crazy. If we get back to 1,000, I'm also going to go back to 4, though. So in other words, what I believe would be a 4-point drop based on what I thought I understood about the amount this thing moves. But either way, oh yeah, see, now it's moving more like what I expect. Isn't that weird? It's so annoying. Now we're getting big chunky moves when it moves down. Before we weren't. But anyway, so at about $1,000, I'm going to be happy enough to pull back. So that's my plan at the moment. Hopefully we fail these lines and have a little bit of a sell-off into the close. 69.40 then I think is a great shorting line on the now see, that's the thing, if you're playing the other way, 69.40, keep very tight stops, you can't get into trouble, but you can possibly get a nice move down that makes you a lot of money. So effectively, when I added 4 more positions at this level, I'm adding, so I have the one conviction trade where I added 2, but now I'm playing a tight stop trade as well on top of it. And when I get out, I'm going to get out the 4 new ones I added, and all they're going to do is sort of is going to lower the loss I had on the 4 original ones. So it's sort of a combination of playing styles, but the most important style to learn is the tight stopping style, because that obviously is critical to me getting my money back on this one. See, I'm at 12.50 now, so it's almost like, gosh, I should really just be happy I'm at 12.50. But I think we can do better. All right. So anyway, that's going to be it. And if anybody else has a question, I'll answer that. But otherwise, no. I have one. It's very functional XD. I have one more. A short. Oh, okay. And John says from Thinkorswim, China's Wang Yi and its trade talks leaders have made constructive. Oh, okay. That's another big positive. But if that's at 307, then that hasn't even hit the wire. I mean, that hasn't even caused a reaction at this point. I think right now though the China back and forth thing is it's kind of becoming noise, and it's more of a wait and see kind of thing. So I think we need a little bit more than that, because it's like every day it's like it's on, it's off, it's doing well, it's not doing well. But and also what China considers constructive, it may not be what we consider constructive. China considers it constructive because Trump rolled over and let them do what they want. It's like a dog when they get submissive, right? Here we go, 1145. It's exciting for me. I don't know if it's exciting for you. 1125. Ow, come on, man. Here you go, 1065. Oh, is he being too greedy? Is he? Okay, I gotta take that. 1025. I'm locking that in, baby. 965, loving it. 915. See, now I'm back to 4. Obviously, I won't make the money up as fast now going back down, but I'm happy. I cut my loss in half. I have a very manageable amount. And now if it goes up, I don't mind doubling down again. I certainly wouldn't want to double down if it had 8, but if it goes back up, I'll be happy to double down. It's going to raise my basis even further and make it more likely I can recover. Or if it just goes down, sure, it'll take me like a couple more points to make it up, but at least I got a very good chance of getting flat. And by the way, when I get to even, I'm going to go back to 2 short. Oh, look at that, 695, son of a bitch. All right, so that's a fantastic example of how you scale in and out of position. Because don't forget, I started at 6,900 with 2 short contracts, and I've been totally wrong for 40 points. Yet I've only lost 855 at the moment. But now I have 4 contracts, and I only have to get, and if I get back to even half of where I was before, I'm going to be profitable. Because I scaled in and scaled out of my position. And imagine, what did I do? I had 6 bullish trades and 10 short trades, which is why I have 4 contracts left, right? 4 shorts left. I made 6 positive moves and 10 bearish moves during the time we've been looking at this trade. So if you want to learn how to do scaling, go back and watch this a few times, because that's basically exactly how you do it. And hopefully it'll work out in the end, but even if it doesn't work out in the end, I brought the loss down to a manageable level. Like I said, it's a row on the craps table at this point. So it either makes money or it doesn't. You know, I can go to sleep very happily on that and not be too worried about losing a lot of money. All right, so thanks a lot, guys, and we will do it again next time. But by the way, I do like this trade for an overnight trade. Well, it's a little late now, but at 69.40, I thought that was a fine short. And obviously, 27.28, you can short ES too, with a stop above 27.28. And when I say above, look, right here, you can see 27.29.85 is where it stops. So 27.30 is your stop. ES is $50 per point per contract, though I have to call the whole system into question now because it doesn't seem to be acting the way it's supposed to. But last I looked, the S&P was $50 per point per contract. So if it goes 2 points against you, you're risking $100. That's your risk. If it goes back down to 27.18, which is how we played this, which is how we played it yesterday for a 10-point drop, you're going to make $500. So you're risking $100 to make $500. That's a good risk-reward ratio. That's all we ever look for when we're trading the futures, is to set ourselves up for good potential rewards compared to the risk we're planning on taking. That's what this is all about. All right. Thank you, everybody, for coming by, and we'll do it again next week. All right. Take care.